The investment industry has a language of its own. Often new words are invented, old words are given new meaning, and there are a slew of acronyms thrown into the mix. In fact, a lot of investing words are created by market pundits or experts to sound more intelligent than the average person, which in turn helps them paint a picture that they can do a better job than the everyday investor, and paying them good commissions is therefore justified. After all, how on earth is an investor likely to understand words like
free cash flow generative,
focus on effective diversification,
momentum,
create alpha,
while we're causing the valuation discrepancy to narrow,
distortion in pricing,
the hedge fund,
fundamental,
bottom-up earnings yield,
their index plus an alpha strategy.
wow, that was something, wasn't it? So in this video, we shall look to reconvert some of these complicated jargons used by market gurus into more reasonable and meaningful terms that people like you and me can better understand. The animal kingdom has made many contributions to the stock market dictionary. The most commonly used ones here are of course the bulls and the bears. A bull market quite simply means that the stock market is on an upward spiral and is continuously rising. While there is no specific and universal metric to identify a bull market, most experts define a bull market as a rise of 20% or more in the stock prices, which comes after a previous 20% decline and is followed by another 20% decline. Per this definition, and from an Indian context, the periods between 2003 and 2008 and again from 2014 to 2019 do qualify as bull markets. On the other hand, if an expert uses the word bear market, then it represents a period of prolonged fall in the prices of stocks on a consistent basis and is reflective of investor pessimism and negative sentiments. On a mathematical basis, a bear market is said to have happened if the stock prices fall by 20% or more from the recent highs. Another animal that gets featured in the stock market dictionary is the dog, which can be construed in two very different ways. On the one hand, a dog can represent a stock that is a chronic underperformer and therefore something that drags one's portfolio returns. But on the other hand, a dog stock is one that offers consistently good dividend yields. In fact, there is a popular strategy called the Dogs of the Dow strategy that is built around buying the top 10 highest dividend yielding stocks. Yet another animal in our list is the unicorn, which in investing language represents a privately held startup company that is valued at over $1 billion. As of April 2021, there were 654 unicorns all around the world, with many of them going or gearing to go the IPO way, thereby accessing the stock markets for growth capital. Analysts and stock market experts have a strategy for everything. In fact, you can take any investing related word, suffix it with the word strategy, and it will start looking a bit more intellectual. But two of the most common ones that you're likely to encounter are the active strategy and the passive strategy. An active strategy simply means that the fund, or rather the fund manager, is actively engaged in picking individual stocks, which means he or she starts with a universe of 100 or 1,000 companies and then picks up a few 20, 30, 40 stocks based on one style of investing and valuation principles. 99% of anyone who comes on televisions and talks about equity-based investing is using the active strategy, including Warren Buffett and Rakesh Jhunjhunwala. At the opposite end of the rope is what is referred to as a passive strategy. As the name suggests, a passive strategy is built on a preset methodology of investing, which generally aims to purchase all stocks in a benchmark or index. For example, if you invest in a Nifty 50 index mutual fund, then you are employing a passive strategy. Now, a variant of passive investing that is steadily becoming a movement in itself is called factor-based investing. So what is factor-based investing? It's sort of a combination of both the active strategy and the passive index strategy, and allows investors to target specific risk and return factors. For example, say you want to invest in only low volatility stocks. So that's a factor and an index is created specifically for that purpose. Similarly, there are many factors that can be explored by investors such as value, size, quality, volatility. But the biggest of them all is the word that you might have come across many times, and that word is momentum. When an analyst or fund manager says that they employ a momentum investing strategy, it means one is buying the securities that are rising in price and selling the stocks whose prices are falling. On the face of it, this might sound counterintuitive. After all, who wants to buy high and sell low? But many studies have proven that this momentum model actually works and is something we have discussed in greater details in one of the many videos that we have on the ET Money YouTube channel. The last jargon on our strategy list whose use is increasing by the day is the word alternative investing or alternatives. The alternative investing strategy requires looking beyond traditional investment avenues and holding more exotic asset classes like private debt, private equity, hedge funds, real estate, commodities, collectibles, cryptocurrency, and structured products. This is again a growing trend, and we now see NPS fund managers and even mutual fund schemes doing some limited investing in alternatives. Bunching up similar or comparable elements is a very common technique that is employed in just about everything, including investing. For instance, you would have heard of the word blue chip stocks. It's a very common phrase, but truth be told, no one really seems to know the measurable definition of a blue chip stock. I mean, for most people, it is broadly assumed that a blue chip stock is a well-established large cap company which has a high market share in key industries, that offers good dividends, and has shown stable and reliable growth for many years. Now that's a lot of words, but in all honesty, it does not on a quantifiable basis help me understand if companies like Bharti Airtel and Ultratech Cements can be called a blue chip stock in spite of being India's 11th and 19th largest listed companies. Another such stock related phrase one might have come across is what is referred to as a defensive stock. Quite simply, a defensive stock is one that is less volatile than the overall stock market. However, the general assumption of a defensive stock amongst everyday investors and even some market gurus that we see on TV is that these are stocks of particular industries like FMCG, utilities, and healthcare. But the real definition of a defensive stock is surprisingly a mathematical one and simply requires the beta of a stock to be a lot less than 1. Yet another bunching of companies we often come across is the income stocks. An income stock is one that pays regular dividends to its investors and is mostly issued by firms with stable cash flow and a large market capitalization. Another homogeneous grouping is growth stocks, which represents companies whose stock prices are anticipated to grow at a rate significantly above the stock market growth rate. Again, while there is no stringent filter here, growth stocks are typically ones that trade at a high P ratio, whose sales growth is higher than other companies, may not have earnings presently but is expected to have a lot in the future. They often don't give any dividends and have unique product lines and are market leaders in a fast-growing sector. Growth stocks are often compared with value stocks, and value is where a lot of chit-chat is happening nowadays in business channels. A value stock is one which is perceived to be trading at a market price that is below the future estimated price. This future estimated price is also called the stock's intrinsic value. So when one hears the word value stock, imagine a stock which is probably not growing as fast as other companies in terms of sales or profits. This company has good and reliable cash flows, has a low price earning ratio, its stock price is not doing much over the last few quarters, and yes, value stocks are generally ignored by analysts, fund managers, and the public at large in most discussions. Of course, what I said right now is nothing but a generalization, but we will be talking more specifics on value investing in a series of videos we have planned over the next few weeks. So if you haven't subscribed to the ET Money YouTube channel, then kindly do so and tap on that bell icon for timely alerts. In this section, we look at the most commonly used words by stock gurus which might otherwise be very uncommon to all of us in our everyday lives. For instance, there is the word alpha, which in Greek alphabets represents the number 1. But when used in investing, alpha represents the relative returns of a stock or mutual fund when compared to the overall market or the benchmark against which it is being measured. For example, if a large cap fund has delivered 15% while the Nifty 50 grew by 10%, the alpha is the difference, which is 5% in this case. In the same context, when a market expert says that the alpha can be generated by doing X, Y, and Z, he or she is giving you a prediction that if you do these X, Y, and Z things, you can make more returns than the overall market, which in other words means that you can beat the market. And speaking about predictions, it is also a common practice to predict the central bank, that's the Federal Reserve or the Reserve Bank of India's interest rate movement, which often has a significant impact on the stock markets. Now, for some reason, the financial markets tend to use references to doves and hawks, thereby making an everyday investor's understanding all the more complicated. So when the RBI governor or a market expert says that the monetary policy is dovish, it means that the RBI is keen on keeping the interest rates low in a bid to stimulate economic growth. On the other hand, if the monetary policy is hawkish, then the central bank aims to keep the interest rates high, which is mainly done to cool off economic activity and keep the inflation in check. Now, of course, instead of saying dovish and hawkish, the stock market experts could have really kept it simple and said that they want to keep the interest rates low or high. But then what's the fun in that? Dovish and hawkish sounds so much cooler. In fact, another weird set of terms are related to a person's body mass index or BMI. I mean, we hear these two words all the time, overweight and underweight. But what do they really mean? When an analyst says that he's overweight on a particular sector or stock, what he really means is that this stock or sector deserves a higher weighting in a model portfolio as he expects the price to go up in the future. And on the other hand, if you hear the word underweight, then it means the analyst is winding down that stock or sector's allocation as the price is expected to go down from here. So overweight means you can buy and underweight means you can sell. A third weight category we also hear is equal weight or neutral, as it is sometimes called. As the name suggests, it means the weightage is not likely to change much from where it stands today, and the stock or sector performance will be in line with the average returns of the index or the benchmark. Okay, so we've covered 20 jargons so far. So let's have just 2 more. And again, if you hear any fund manager interview, you're likely to come across these 2 terms, bottom-up investing and top-down investing. When a fund manager says that they use top-down investing approach, what they actually mean is that they try to identify the big picture first. That is the consumer demand, the GDP growth, inflation, consumption of goods, and other macroeconomic variables. And on this basis, they choose which stocks to invest in. So graphically, this is a top to bottom movement with the macroeconomic variables at the top from where the movement starts, and then in the middle we have the sector or industry specific variables, and in the bottom are the stocks pertaining to that sector. On the other hand, a bottom-up investing approach focuses on specific characteristics of an individual stock before moving to a sector analysis and then pairing it up with some macroeconomic variables. And with this, we come to the end of this video, and I hope there is a lot more clarity on some of the more complicated investing terms. It's remarkable that we have covered almost 24 such terms in this video, and this is just the tip of the iceberg. If you too come across some investing terms which have left you confused and perplexed, then do type it in the comment section below. Once again, thank you for your time. Do subscribe to the channel, do like this video, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.